Pillow talks taxes. He has been for over 45 years, and there isn't a human on the planet who has more experience solving problems on behalf of taxpayers. He wants to solve your problem, whether you know you have one or not. And if you do have a tax problem, call our office or visit TaxHelpOnline.com to get the help you need. If you don't have a tax problem, your current tax problem are taxes themselves. So let's get into the policy issues of today. And coming up here is April, which is tax filing season. And that means that there are going to be millions and millions and millions of mistakes made when it comes to filing returns. What are the most common mistakes that people should avoid?
Well, there's a couple of things, Josh. First of all, you got to make sure as a tax return filer, you got to make sure that you've got all your income documents, the 1099s and W-2s. And a lot of people tell me, and I see this happen over and over again, where people will say, well, I filed my tax return before I got my 1099 or got my W-2. I didn't include it in the return. Double check with your bank deposits to make sure that you're counting all your income. It is very important that you count all of your income and put that income on the tax return.
So double checking bank deposits, double checking income statements. What are all the things that people should be looking for?
Well, here's another problem with W-2s and 1099s, information returns. American industry files, businesses and industry file about 5 billion information returns with the IRS. That's with a B, 5 billion information returns. These are 1099s, W-2s that report income paid by one person, one business to another. There's a lot of errors in connection with those 1099s, Josh, with those information returns. They are error-ridden. And I am dealing with people all the time who get these erroneous 1099s. They got, it might report interest you never received. It might report income from business you never had anything to do with. It might add an extra zero on there. I had a client one time that got an information return from a corporation that supposedly paid her a bunch of money. And they did pay her money. They paid her about $13,000, only they added a couple of extra zeros. So it looked like $1.3 million on the information return when in fact the number was more like 13,000. And so these kind of errors happen all the time. So you need to double check the information return. If there's an erroneous information return that you have received, you need to contact the payer. Who issued that form? Get back, point out the mistake, demand that they correct the mistake. If they don't correct the mistake, you need to deal with it on the tax return, all right? Because you can't just ignore it. You got to deal with it on the tax return because the IRS is going to send you what's called a correction notice. If you file that return without reporting that 1099 somehow, they're going to send you a correction notice. They're going to add that income to your tax return. The IRS has no way to know whether it's erroneous or not. So you have to deal with it on the front end. What I recommend you do is send that issuer a letter specifically explaining why the notice is wrong and demanding that they fix it and submit a corrected notice to the IRS.
Well, this just goes to show how much extra effort there is in complying with the system that we have at the moment. What does someone do other than, demanding that the erroneous letter get fixed? If the issuer won't fix it, what else can be done? Is there anything that you can do?
Yeah, that's a good question because often these big businesses aren't going to fix them. They're just going to, they won't even answer your letter. They'll just ignore it. What you need to do in that situation is you use IRS Form 8275. IRS Form 8275 is a disclosure statement. It allows you to make a report with the IRS that explains a potentially questionable item in the tax return. So you provide information to the IRS that will answer questions that are raised by the return. So I would explain in the 8275 why the income on the erroneous 1099 is not reported. And I would explain that you reached out to the issuer of the 1099, you asked them to correct it and they refused to do it. I would plainly state on the 8275 that the information return is erroneous and you're not reporting the income because it's erroneous. This is one of the rare occasions where the burden of proof is actually on the IRS. Ordinarily, the burden of proof is always on the citizen. The IRS almost never has to prove you did it wrong. You have to prove you did it right. But when we're talking about an erroneous information return and you as the taxpayer provide information to the IRS to support the idea that the information return is erroneous, if the IRS wants to rely on that information return to add additional tax liability to your tax return, they've got the burden of proof, Josh. So they actually have to come up with fact, circumstances, with evidence and documents to support the idea that the information return is in fact correct. And of course, course, they're never going to do that. That's never going to happen. So when you take those steps that I just described, you are going to be in a solid position to never have to pay taxes on income that you didn't receive. In my book, How to Win Your Tax Audit, I've got an entire section in that book that shows you specifically how to deal with erroneous 1099s.
When you get a 1099 or a W-2, that's a company basically saying, hey, we paid you this money and we had alerted the IRS that we paid you this money so that you got to go pay taxes on it. Does that mean if you don't get one of those notices, you don't actually have to pay taxes on the money?
Well, no, it doesn't mean that at all. And that's a very common misconception. People think, well, I guess I don't have to pay income taxes on this money because I never got a 1099. And I hear people say that all the time. But fact is, no, that's not true. You have a responsibility to report income from any source, regardless of whether it is reported to the IRS by a third party. If you've got a side hustle, for example, you're working a side business and you're doing, I don't care what it is, just fill in the blank, and you're getting paid to do that. You're getting paid by the public. You're not getting paid by another company. You're probably not going to get a 1099, right? So if you're working as an independent business person somewhere, well, let's say you're a garage mechanic, right? And you're fixing brakes and you're fixing transmissions and you're doing these basic things out of your garage as a part-time job, and the people are coming to you for help. They're paying you, and whether they're paying you with a cash, a check, or Venmo or whatever, doesn't make any difference. You've got a responsibility to report that income. Any income, unless it's specifically excluded as taxable income by the tax code, has to be reported on your return. So things that don't have to be reported as income would be loans, for example, returns of capital. So if you sold stock and you got money back, the profit on the sale of the stock is taxable, but not the return of capital. A gift, any gift or inheritance that you receive from somebody, those are not taxable income. There's an entire segment of receipts that would not be considered taxable. But any income that's earned by you in the course of providing services to somebody, selling goods and services, that's taxable income, has to be reported.
That's a crazy dichotomy to me. The idea that you can be gifted something, completely not work for it whatsoever, and not have to pay any taxes on it. But the second you put your hard elbow grease into fixing something, making something better, and earning money for yourself, then the government, they want their little taste. It's a kind of a screwed up version of how our tax system works.
It's a bit of an odd policy. Loan proceeds also would not be taxable income, these types of things. There's tens of millions of people out there. There are tens of millions of people out there that are running some kind of side hustle from their basement, from their garage, from the spare bedroom, and they're earning extra money, a couple $1,000 a month up to, a substantial amount of money.
In this economy, you have to.
Well, that's true. And as a matter of fact, a lot of people think in terms of financial independence by starting their own business. If I can start my own business, if I can build up my own business, I can be my own boss. I don't have to work for some jackass employer someplace anymore. And I don't have to punch a clock. I don't have to listen to somebody else's rules and adhere to their arbitrary rules and deadlines and so on. I can be my own boss. That's great.
Until you realize that all those arbitrary rules and deadlines are then made up by the IRS that you got to follow.
Well, the IRS has got plenty of arbitrary rules and deadlines. In fact, I would argue to you that the entire Internal Revenue Code is just a barrage of arbitrary rules and deadlines. It really is. And that's one of the difficult things about studying the tax code and learning these various things, is all of this stuff is so arbitrary. But back to the point that I'm making here is when you are self-employed, you've got a responsibility to report that income. However, not all the income is taxable, right? So you have the right to claim a deduction for any expense that's incurred for the purposes of earning income. And this is what self-employed people need to understand. You don't just get money showered on you. You have expenses that are incurred for the purposes of earning that income. And whatever those expenses are, you have the right to deduct those expenses on your tax return. So yeah, you report the gross income, then you report the expenses that you incurred to earn the income. The net income is what's taxable. And so, for example, when you get a 1099 from a company, that company is not going to take into consideration the expenses that you incurred to earn that money. It's your responsibility to keep the records of those expenses and to report those expenses on the tax.
It's a very, very complicated system, it sounds like. It also sounds like it makes compliance a lot more difficult. And we could definitely talk about, how much better a retail sales tax, because we do this. We go into that rabbit hole of how much better a retail sales tax would be compared to this system. What else do small business owners owners need to know when it comes to complying with the tax code? And I'm sure that's a pretty broad question.
Well, it is a broad question, but let me just say this: a lot of people, and small business owners in particular, the IRS will claim that most people are cheating on their tax returns by underreporting their income, right? But the fact of the matter is, most people overpay their taxes, and I would argue to you that small businesses are in that group that generally overpays their taxes, and the reason for that is because they're not claiming all the deductions they're entitled to claim. And one of the reasons that happens is because people seem to think that if you claim a lot of deductions on your tax return, that you're somehow painting a target on your chest. And who wants to paint a target on their chest when it comes to the IRS, right? Nobody wants to become an audit target. And so people will say to themselves, and I've had clients say this to me, hundreds of times over the years, I didn't claim all the deductions on my tax return because I thought if I get audited, I'll have something in my pocket that I can lay on the table that will, level the playing field here, so to speak. If, they want to disallow this or disallow that, well, okay, fine, I've got additional deductions I didn't claim. That's the wrong approach, right? It's a wrong approach for a number of reasons. First of all, there's no guarantee that you're going to be audited, all right? The fact of the matter is that the audits are a small component of IRS enforcement. And so, the likelihood that you're going to be audited, you just can't bet on that. So why would you withhold deductions that you're legally entitled to claim on the potential risk that you might be audited? The only thing that guarantees is that you're going to pay more taxes than you owe. The better idea is to claim every deduction you're legally entitled to claim to reduce your tax liability to its lowest legal level and do it without risk. And the way you do that is you audit proof the tax return. You audit proof the tax return with that form I talked about earlier, the form 8275. That's a disclosure statement. So for example, if you're a small business and you've got unusually high mileage, for example, let's say you're a realtor and you're running all over the place, driving your car everywhere, and you amass thousands of miles. Some of these realtors amass 25, 30,000, 35,000 miles over the course of a year, driving around doing all these real estate showings. Well, if that's the case, that might be a high number. But the fact is that if you provide information with the return that answers potential questions raised in the return, you substantially reduce the risk of a face-to-face audit by doing that, and you use the form 8275 to do that. So don't withhold deductions on your tax return that you're legally entitled to claim. Claim the deductions, but audit proof the return so you don't run the risk of getting a face-to-face audit.
So there's many ways that business owners can lower their abilities in the legalist possible way, in the legal sense, lowering their liabilities. And by doing that, essentially, in order to do that, they have to claim every single deduction. But what else can they do in order to lower last year's liability? Most of those deductions have to be claimed in that year, right? So
yeah, you're exactly right. So now here we are at March of 2025. Your 2024 tax year is closed out, right?
Right.
So you're not going to incur any expenses in 2025 that you're going to be able to write off in 2024 as a business owner. But any individual can make a contribution to a new or existing IRA or 401k up to April 15th, right? So you've got until April 15th of this year to make a contribution to a retirement savings account and claim that deduction on the 2024 tax return. That's the only thing that's available right now to taxpayers to do in 2025 that will affect 2024. And it's the IRA contribution right now, 401k contribution, is up to $7,000 per individual that's got earned income. You have to have earned income to be able to do this. And if you're over 50 years of age or older, you can contribute $8,000. It's called a catch-up contribution. Allows you to put more into your retirement account than you otherwise would. So again, this can be done up until April 15th of this year. Claim the deduction for last year.
Pretty much only one thing you can do. There's nothing else you can do in 2025 to lower 2024's liability?
Nope, nothing else. That's it. That's the end of the road right there. Now, for 2025, however, and again, I'm talking about business owners in particular, you need to start tracking your expenses very carefully. The typical small business owner that I come into contact with, Josh, has a filing system, an expense filing system that consists of the floor of the front seat of their truck, right? They're not keeping track of these expenses. The receipts go on the floor if they even have a receipt at all. They're just simply not paying attention. And their bookkeeping system amounts to this simple equation. If I've got got money in my pocket, I must have earned a little bit. If I don't have any money in my pocket, I guess I didn't earn anything, right? That's not a very good bookkeeping system, and it's certainly not a bookkeeping system that's acceptable to the IRS. The IRS does not define tax code. In all 4 million words of the tax code, Josh, there's no definition of a record keeping system, right? So you can have any kind of record keeping system you want. The only rule in the Internal Revenue Code is that that record keeping system accurately reflects the receipt of income and the payment of deductible expenses. So you got to have some reasonable system that tracks what you're doing in terms of receipts in, money coming in, and expenses going out. And I will guarantee you this, if you take a little time to set this up and you babysit it a little bit so that you're capturing your expenses, it's actually going to pay you to do that, because you will capture expenses that you're probably now losing, you're not getting the benefit of. And so by doing this, you're going to reduce your tax liability probably considerably for most people. And I'll give you another example. When we're talking about small businesses, probably the number one, certainly the top 5 deductions for small businesses is the mileage expense on their automobiles. Well, a lot of businesses don't keep proper mileage logs, Josh. If you're tracking your mileage log properly, I will bet you that you're going to increase your deductible mileage considerably and give you the advantage of using that deduction to reduce your tax liability. In my book, Dan Pilla's Small Business Tax Guide, I have an entire chapter in there that shows you how to track that mileage expense. And I've got visual graphics in the book that show you exactly what leg of a business trip is deductible and which legs aren't. If you've got an office in your home, then this leg is deductible and this one's not. If you go to work at an office every day that's outside of your home, then this leg of the trip is deductible and this one's not. I have graphics that illustrate that to make it remarkably simple so you can capture all of your deductible expenses.
Definitely seems like mileage is one of those that people are afraid to. It definitely seems like that's the one that they don't feel like the IRS will believe the most.
Well, you're exactly right. And as a matter of fact, that's the one that the IRS challenges the most for small businesses. But the fact is, if you've got a proper mileage log, they can't, they can question it, sure, but they can't disallow your mileage expense when you've got that mileage log. You need to have the confidence in your mileage log that it reflects the things that it's supposed to reflect. And there's no way the IRS is going to be able to tamper with your mileage. There's just no question about that.
All right, so I can think of one other thing that will lower people's tax liabilities for 2024 in 2025, and that's paying the tax on time. Because if you don't do that, then you're going to end up with penalties and interest, and that's going to back on the bill. So what if you can't pay your taxes on time? What do you do?
Okay, well, yeah, that's a good question. So for you got 3 potential options here if you can't pay your taxes by April 15th. Option number 1, this is probably the best kept secret that the IRS has from the American public, and that is you can get an extension of time to pay your taxes. All right, everybody's familiar with the extension of time to file your tax return. That's IRS Form 4868, gives you 6 additional months to file the return, no questions asked, no failure to file penalty. All right, that doesn't give you more time to pay the tax. Tax still has to be paid by April 15th. But if you use IRS Form 1127 you can actually get up to 6 additional months to pay the taxes now without penalty. The interest still accumulates, no doubt about that, but you can get rid of the penalties. You can avoid the penalties. Now, the difference between the filing extension and the payment extension is the payment extension is not automatic. You got to submit the form. You got to give a reason why you need the additional time to pay. You got to demonstrate, Josh, with some specific explanation as to why payment of the tax on time will cause a hardship. The term hardship is defined as the inability to pay necessary living expenses. So if you're in a situation where you literally have to make a choice between paying your taxes and feeding your family, that's the definition of a hardship. And that is the kind of showing that you have to make on that Form 1127. Now, if 6 additional months are not going to be enough time, then go to Plan B. Plan B is to use IRS Form 9465. Form 9465 is called an installment agreement request. That'll set the wheels in motion to get you set up on an installment payment to pay over time. Now, if you owe less than $50,000 and you can pay within 72 months, the IRS will just about, not quite, but just about rubber stamp that installment agreement request to give you that opportunity to pay the tax over time. Problem with that is not only does interest accrue, but you have failure to pay penalties as well. Even when you're set up on an installment agreement, Josh, they still charge you with failure to pay penalties, which is reprehensible in my opinion, but that's what they do. Now, that said, can get rid of the penalty if you can demonstrate that you acted in good faith based on a reasonable cause for your actions and didn't deliberately disregard your financial obligations with regard regard to the IRS. What if you're in a situation where you're either unemployed or underemployed and you can't make any payment at all? All right. In that situation, then the IRS has a program that they call currently not collectible. It's called colloquially referred to as uncollectible status, where you go into the IRS and say, look, guys, I owe this money, but I don't have any capacity to pay. I can't pay $200 or $300 or $400 a month overtime. I can't pay anything because, as I said, I'm unemployed or underemployed. In that situation, the IRS has the authority, freeze the collection account, put the case on hold, set it on the back burner, and not enforce collection whatsoever in a situation like that until you get back on your feet. So those are the three options: extension of time to pay, Form 1127, installment agreement request, Form 9465, or the uncollectible status hardship termination that will freeze the collection account.
All right, so there's definitely options for people if you can't pay this year's taxes, but that's all we got for this week. So thanks for watching, taxpayers, and remember, there's no such thing as a hopeless tax case, and if you think yours is the exception, call the office or visit our website, get a hold of Dan here, and help you see the daylight. Dan, tell them where else they can follow along with your taxpayers' rights crusade.
Follow me at Pillow Talks Taxes. I'm primarily on TikTok, Facebook, Truth Social, and right here on YouTube. Make sure you subscribe, like, and share these videos, especially with your federal and state representatives. And if you have a tax problem, go to my website, TaxHelpOnline.com. You will get the help you need.